Good afternoon and welcome to this ICAEW webinar about the pitfalls and the new opportunities of fund accounting, which we're bringing you in association with MHA. My name is Christina Kovic. I'm the head of charity and voluntary sector here at ICAEW, and I will facilitate this session today. Fund accounting is a vital part of charity accounting, and without a firm grasp of the charity's funds, financial planning, cash flow forecasting is inevitably flawed. Moreover, where restricted funds are applied incorrectly, this could constitute a serious breach of trust in charity law. So I'm very grateful that to our two speakers from the accountancy and the legal profession, who will discuss common errors, explore more complex fund-related matters such as permanent endowments and total return accounting, and highlight changes to fund accounting arising from the Charities Act 2022. But first, some housekeeping points. As always, we encourage you to get involved with today's webinar. You can submit your questions to us at any time by typing them into the Q&A box. You can also upvote questions posed by other delegates. So if you see a question that you also want to hear the answer to, please just click on the thumbs up icon next to the question, and that will help us prioritize the most popular questions. And this is a very, very popular webinar today. So please make use of the upvoting functions, because we probably won't have enough time for all of the questions. But we have allowed plenty of time at the end of the presentation, so please still keep your questions coming in. Closed captioning is enabled for this webinar. So to turn on this feature, click on the CC icon on your screen. But please be aware that these are automatically generated, so they may not be 100% accurate. We will also post some links to upcoming webinars in the chat box shortly. They will cover lessons from internal audit for charities of all sizes, taking place next Tuesday, the latest research of charity fraud with practical tips on how to safeguard your charity on 1st of December, and as a final webinar for 2023 on the 7th of December, Sage and Tact will share how to shorten the reporting cycle for charities. Also a reminder that our Charity Conference 2024, which takes place virtually on the 18th and 19th of January, is now open for registration. Make sure you book your place early to take advantage of the early bird discount. We'll put links into the chat, but you will also receive them in the follow-up email to this webinar. Now let's introduce our two speakers for today, Stuart McKay and Jonathan Brinston. Stuart McKay is a not-for-profit partner based in MHA's London City office. He oversees a group of 25 individuals who are dedicated to advising and auditing the not-for-profit sector. Stuart has been auditing not-for-profit organizations for almost 20 years, and he holds the ICAEW Diploma in Charity Accounting. Jonathan Brinston is a partner at BBB Pitmans. He advises on a variety of issues affecting charities and purpose-driven organizations. Jonathan has helped national and international charities deliver strategic projects in areas such as governance, fundraising, and risk management, and he is a trustee of several charities. We will shortly post a link to the presentation slides in the chat, but you will also receive them tomorrow by email. So for now, let's hand over to Stuart, who will start off the presentation.
Many thanks, Christina, and thanks for that very warm welcome and good afternoon, everyone. Let us go through the agenda today. So there's going to be two halves to this webinar. I will cover some of the basics, current practice and common errors, and then we'll get into the new exciting, flashy stuff with Jonathan, who's going to take us through what's new in the Charities Act 22. So just a little bit on my bit, we'll take a sort of quite a quick canter through some of the restricted funds, the sort of common basic stuff. We will then go into a bit of highly complex stuff in terms of total return accounting for permanent endowments, and then we'll talk about some sort of common pitfalls and breaches in trust and remedy and so forth before we pass on to Jonathan. So without further ado, let us go through. Hopefully some of this is very familiar to you. Restricted funds, what are they? Funds, they're held on specific trust under charity law. Those are classified as restricted funds, and what it's really about is specific trusts are there to establish a purpose for which the charity can lawfully use those funds. It's obviously possible to have more than one. So this is our known and loved reserves diagram. Over to the right is the stuff we're not going to be talking about today. So that's our unrestricted funds in terms of the designated and free reserves held for the charity. Today, we're going to be talking about restricted funds, and that comes in two forms, which is endowment funds and restricted income funds. These are all determined by trust law, can be complex. So just be aware that we're dealing with some of the finer points here. Restricted funds, as I mentioned before, are classified into two sections, endowment funds and income funds. So let's start off with the income funds first of all, and we'll come back to endowment. Two ways in which income funds are restricted. Either they are donor imposed or funder imposed restrictions, which is often set out in the terms of the gift. Or secondly, they could be restricted by appeal, often by a fundraising appeal. And that's essentially made by the charity when it raises those funds. So what do we need to worry about when it comes to restricted income funds? Well, they need to be spent or applied within a reasonable time frame, and they are there held for a specific purpose. So what that means is that in broader terms, that the purpose of those funds has to be narrower than the overall objects of the charity. What are you required to do? You're required to maintain accounting records. So you must be able to separately identify each restricted fund, be able to record the income and expenditure received from each of those funds. So nice and simple so far. In terms of what are you allowed to expend from those income funds, well, subject to what the terms and conditions that might be included in a grant document, the standard approach is to say, right, well, first of all, we take the costs that are directly attributable to the activities that we're undertaking in order to carry out the purposes that the fund was intended for. Then you're allowed to attach a reasonable allocation of support costs. I've highlighted reasonable there because it's an area of judgment. And you're also allowed to attribute associated costs with either fundraising or managing those funds that go into the pot there. And that is essentially what you're allowed to put through as expenditure towards those funds. Where do we go wrong in some of this? First of all, you will sometimes see negative restricted funds. It's worthwhile pointing out that realistically, funds are only really allowed to go negative under one situation, and that is where there is a realistic expectation that in the following year or future years, you will get further restricted income that will actually recover that shortfall. Deficits are not there to show that essentially you have overspent a fund or that you've plugged the gap from unrestricted funds. That's not appropriate. Where else do we see things going a little bit wrong? And this is actually in terms of narrative and disclosure. So the SORP, the Statement of Recommended Practice, says that you must provide information on all material individual fund balances, and that includes the movements that you've had in the year, the purposes in the narrative, and any reasons for any transfers that you've made. And the SORP gives you an illustrative table of how you might like to set out the figures going in there, and also encourages you to make narrative disclosures below. Do note that if you have small funds with similar purposes, those can be aggregated into one fund disclosure there. Now we come on to one of the more complicated areas of income funds, and that often arises when you're buying assets with those funds. This is where you've got essentially a tangible fixed asset where it's funded either through appeal or by way of a grant or a donation. The question then arises, well, what do I do with it once I've then bought the asset? And so if there is an ongoing, it all depends on the nature of which the funds were raised or given. So there's three normal examples of where this can happen. The first one is where those terms of which you've raised the asset actually require that asset to have an ongoing specific purpose. So you've got to keep the asset going to perform a specific purpose or activity. In that instance, what you do is you continue to hold the asset as a restricted fund, and the depreciation gets washed through restricted funds in future accounting periods. The next example is where once you've built the asset, the restriction actually goes away. You can then use that asset for general charitable purposes. So in this instance, you might well have raised funds by an appeal to build an asset. Once you've then constructed that asset, essentially there is no ongoing restriction over the purpose of that asset, providing it's obviously used for charitable purposes. In this instance, you now release that restricted income through the transfers, and then future depreciation goes through your unrestricted funds. And then the third common example is just taking example 2 there, where you've got an asset, it doesn't have an ongoing specific purpose that needs to be restricted by. However, the terms of the funding that was given to you require that should that asset be sold, you're then asked to, or you're required to pay back either all or some of the proceeds back to the funder. In this instance, well, once again, we don't hold it as a restricted fund because there is no ongoing restriction over its purpose. What we do is we transfer that through to unrestricted funds, and the depreciation gets washed through unrestricted funds. But we do disclose a contingent liability that says, should we sell this asset, some or all of the proceeds would have to go back to the funder. Other little bits of common errors that we need to sort of go through is sometimes the misuse of transfers. So if can we make a transfer in the following examples? If we have an unrestricted fund which are used to finance a deficit on a restricted fund, so can we take money from unrestricted funds and then put them through to restricted funds? Yes, you can. Can you transfer can you transfer an asset like we've talked through from unrestricted to unrestricted funds? Yes, you can. What about if you've got restricted funds that have lawful releases and transfers to unrestricted funds? Yes, that's absolutely fine. Where trustees have exercised the power to declare a special trust or a gift over a gift that's initially recognised as unrestricted, so that's now taking it back into restricted. Yes, you can use transfers for that. And where charity law permits you to use the proceeds of restricted funds to be spent on alternative proceeds, such as CPRE or a failed fundraising attempt, and Jonathan's going to cover some of the new rules regarding that a bit later. Yes, you can. What about to apply support costs to restricted funds? No, you shouldn't really use transfers for that. That should go through the expenditure column. And if we want to tidy up our fund register for little bits and bobs, no, you shouldn't use transfers for that either. Okay, so that's income funds. Now let's move on to the even more complicated endowment funds. So this is split into 2 camps, the expendable and the permanent. Let's just think about what endowment funds are and what you're required to do. Trust law requires a charity to either invest the assets of an endowment, and this is commonly termed as investment endowments, or you're actually you've got an asset or something in there that you're required to retain for the charity's general purposes and in the furtherance of your objects. That would be a functional permanent endowment. So that might be a building, for example. So where do we go with expendable and permanent endowments? This graph probably looks a bit more complicated than it needs to be, but I'll sort of talk you through it. On the expendable side, what this is saying is you have the power to convert both capital and income funds towards that are generated from the endowment to income funds. So you can make a choice there where you can hold some of the capital value indefinitely, or you can apply it to income funds. As opposed to permanent endowment funds, this is where you don't have the power to convert any capital gains towards income funds. It's only the income that's generated off of that endowment can you then apply to your income funds. The capital has to be held indefinitely. What do we do with those income funds? Well, it always depends on the nature and the terms of the gift, whether those income funds are then either restricted or unrestricted. Then we come to the next sort of commonly misunderstood bit, and this is where in accounting terms, on the face of your SOFA, which is your statement of financial activities, you are required to present those income funds either in the restricted or unrestricted columns. You don't put those into the endowment fund. Only the capital element goes into the endowment fund. Okay, so now let's go into permanent endowments. And this is where trustees cannot add the income from those investments to the endowment capital unless they have one of two things, which is a total return accounting basis, which we'll talk about in a second, or in some instances, they might have had the power of accumulation, which has a default power of 21 years. I'm not sure whether Jonathan's going to touch too much upon that, but that is quite a legal specific in there. So when we come to permanent endowment funds, there is a sort of standard approach. And this is where essentially you have to weigh up the balances, the needs of both current and future beneficiaries. Because note, in the standard approach, you can only use your investment income to go through to income funds in the current year. So when you look at your endowment, only the investment income that comes from that can serve current beneficiaries, whereas capital movements are there to be pumped back into the endowment, and those will service future beneficiaries. So this is where an investment approach or a policy really does come into force, because you need to make sure that that investment approach balances both the needs of current beneficiaries and future ones as well. So you'll need to think carefully about what you invest in, because you'll need both income return and capital return on an even-handed approach. Unless, however, you adopt this, which is called the total return approach. For this is used on permanent endowment funds, and this essentially has been given further prominence because in the Charities Act 2016, the Charity Commission, you're no longer required to get Charity Commission consent to apply this, so you can do this without any form of consent. And this is where you're now allowed to say, right, well, if I have investment income and capital income, I can now pop that together into a total return, and I can use that to apply to both future and current beneficiaries. So what does this really mean? And this gets a little bit complicated, so you'll have to forgive me here, because I would argue this is probably one of the most complicated areas of charity accounting. In here, what we're saying is on the left-hand side, you were given an original gift. Okay, that's called the value of the trust for investment. That stays there as your original gift. You then have an investment return that comes from that, both income and capital. And then what you do is the red arrows here highlight a sort of a policy decision. You can choose to apply that some of that return to maintain the index value of that original trust. So you'd pick an indexation value, whether it be CPI, RPI, or the Bank of England base rate. That then gets pumped back in to the trust for investment. But then you have the other side, the balance that falls out of that total return gets put into a thing called an unapplied total return. And that's a pot that basically then the trustees can decide what to do with. They can take all of that and apply it to income funds, or if they want to, they can pop it back up into the top for the future years and carry forward that unapplied total return next door to the trust for investment, and they can carry that forward to future accounting periods. And what that basically means now is I can take all of my income and all of my capital returns from that investment since day one when I very first held it, and I can start using that for spending on charitable purposes. What are the pros and cons of this thing? So pros, it unlocks capital funds for total return accounting, which permanent endowments you wouldn't normally be able to get hold of. It does give you a lot of flexibility. I talked about, deciding what gets spent in this year versus what gets carried over to next year. You don't have to apply it to every single permanent endowment fund you hold. You can pick and choose which ones you apply it to. It is less susceptible to drops in short-term returns. So if your income profile suddenly drops off under the standard approach, dividend rates or a cut, for example, that's less susceptible to this. And Jonathan will cover the fact that we've got new powers in order to borrow as well. What are the cons? It is incredibly complicated. So what I've just described to you is it gets, that's just one fund. It can get pretty complicated when you're dealing with multiple funds. It is very difficult, almost, I would probably argue, practically impossible to unwind. Once you apply total return, it's very, very difficult to undo it. In fact, I've never seen it been done. Just be aware that if you get a negative unapplied total return, you're then subject to what's called a recoupment order, which basically means you have to wait until the unapplied total return goes back to positive. And you also need to think about considering now how you're justifying some of those decisions in there. So your unapplied total return now forms part of your reserves, because essentially you've decided to carry some of that forward to future years. So that now forms an additional consideration for your reserves policy. I would always say, if you're thinking of doing total return accounting, you should probably get some advice. Okay, and just before we hand over to Jonathan, I just wanted to talk about some common mistakes that we sort of see both in it's really realistically the application of restricted funds, both through endowments and income funds. The first one I'd say is unintentionally restricting by appeal, and that is where a charity will go out and say, we're raising money for a specific purpose, and they unintentionally are now restricting income by appeal. If you then suddenly decide against doing that project, then you're in a bit of a sticky place, because the only place you can go is either back to the donors and ask their permission to change the purpose of the funds, or you can apply to the Charity Commission. Either way, that's a pretty sticky place to get out of. Failed fundraising events as well is another one we sort of see, and Jonathan will talk a little bit about some of the new rules behind this, but this is where, to the best intentions, you want to try and raise money for a specific cause, and you're going to do an event and put on an event to raise money for that. For a number of reasons, that event is then cancelled or it's failed, and as a result, you're then left with a bit of a quandary with what to do with those funds. And sometimes you can be far too successful. And this is, again, you're raising money by appeal. And it's very important to watch the wording that you use behind that, because you can restrict funds. And if you actually raise amounts in excess of what you intended to do, you're slightly in a sticky position again, because you'll need to get some permission from funders in order to change the use of those funds. So again, it's often common mistakes we see is when you're raising money by appeal, you just need to be super careful about the narrative that you put behind that, and perhaps not be so restricted in your language, and just maybe perhaps include wording such as, should the charity be successful in this event, any excess funds will be used for general charitable purposes. Something like that often gets you out of those sticky situations. So I'm now going to hand over to my illustrious colleague, Jonathan, who I'm really hoping is still there, and he's going to take you through some of the changes to the Charities Act. Over to you, Jonathan.
Thanks, Stuart. And Stuart's going to stay involved, I hope, as my glamorous assistant to do my slides as we go through this. So I'll be barking out to Stuart every now and again to change the slide. So yeah, thank you all for inviting me along to this. And I'm going to now take you through some of the recent changes that have been made by virtue of the Charities Act 22. Stuart, shall we change the slide? Already experiencing, there we go. So you'll see that the Charities Act came into, was passed back in February 22, and it's introduced a raft of changes to charity law. by amending the Charities Act 2011. These are all quite technical changes and that are aimed at reducing unnecessary bureaucracy while maintaining an appropriate level of regulatory oversight, or at least that was the intention of the Law Commission when they made these recommendations back in 2017. Slide, please. So the best things come in threes, and this act was due to come into force in 3 phases. The first of which was in October last year. Then we have some more come into force in June this year. And finally, some have been pushed out to as yet to be determined date early in 24. But the reality is it will probably be 4 phases with various items, including changes to the ex gratia regime, on hold until further notice. Slide, please. So just quickly, these are the items which have already come into force, and you'll see phases 1 and 2, including changes to fundraising appeals as part of phase 1, and changes to permanent endowment as part of phase 2, both of which I will be focusing on in a minute. Slide, please. And just quickly, here are some of the items not yet in force. Notably, still some significant changes to come on the disposal of land, including bringing universities and colleges into the Charities Act regime, as well as the ex gratia payment changes I just mentioned, which are nestling in the long grass for the time being. Slide, please. So that was the overview, and this, I'm now going to focus on fundraising appeals and the amendments which have been made to the law around failed fundraising appeals. So there are effectively 2 scenarios where the new law is seeking to make improvements in relation to fundraising appeals. So under the old regime, where the charity made more money than it needed, the charity could apply to the Commission for a CPRE scheme so that those surplus funds could be used for other charitable purposes. In circumstances where the appeal failed because insufficient funds were raised, say to fix the church roof or buy that much needed piece of playground equipment, you couldn't just approach the Commission to procure a CPRE scheme in the same way as you could do in relation to surplus funds. Instead, the default position was that the charity held that money on behalf of the donors, and it would be required to return that money back to them. And if the donors could not be found, the money had to be paid into court. So clearly that made life very awkward for charities. And so the position was loosened up a bit by iteration in 2008 and then in 2011, which made it a bit easier for the Commission to make a CPRE scheme in circumstances where the donor could not be identified and the charity had made appropriate efforts to find them, including through a publicly advertised notice in a paper or a periodical. And there were also other prescribed scenarios where the charity could, where the money could be retained by the charity. For example, where the donor agreed after the failed fundraising event had taken place that the charity could keep the money from the failed appeal by way of what is known as a disclaimer. Or conversely, if the donor had made a declaration in advance of the fundraising event that the funds could be used by the charity for other activities if not enough money was raised. And even where the Commission made a CPRE scheme, there was still a 6-month cooling off period where the donor could still ask for their money back. So you will gather that the law was not very user-friendly or practical, the main difficulty being in relation to failed appeals requiring funds to be returned unless it was possible to procure a CPRE scheme. Slide, please, Stuart. So the Charities Act 22 has simplified the law in a number of ways, making it easier to apply the funds CPRE, and I will just run quickly through this slide. So in relation to failed donations, if the donation is small, i.e. where a donor has given £120 or less in a financial year, whether by a single donation or cumulatively over the year, then there is now no need to contact the donor, and the trustees can resolve for the donation to be applied CPRE without recourse to the Commission. rather than having formally to advertise in periodicals for 3 months to locate donors, as under the old law, the trustees can agree with the Commission regarding what reasonable steps should be taken to identify donors. So it could be via a social media post, for example. And having followed those agreed steps that you'd agreed with the Commission, and where the donor is still not found, then again, a CPRE resolution can be passed. Funds raised from a cash collection or from a lottery or something similar can now also be applied to CPRE. So in other words, where the collection mechanism effectively renders it impossible to identify individual donors, you have a CPRE option available to you. And finally, in circumstances where the Commission thinks it would be unreasonable to take steps to contact the donors because it would be administratively expensive or disproportionate, or it would be unreasonable for the donors to expect the donation to be returned, then the Commission can make a CPRE scheme in those circumstances as well. And clearly the charity would have to make the case to the Commission to support that. Slide please, Stuart. So in terms of the CPRE process itself, this has also been simplified so that if the amount is under £1,000, no Commission consent is required, albeit that the trustees must still have regard to whether the new purpose is similar to the charitable purpose for which the money was originally donated, and that the new purpose is appropriate in light of the prevailing social and economic circumstances, all of which should be recorded by the trustees in supporting minutes. Commission consent will still be required if the sum is over £1,000. The CPRE resolution will now take effect when the Commission has given its written consent to it, and there is no longer the 6-month cooling off period. However, as Stuart was talking about, it's worth stressing that the easiest solution to this problem is simply to have the right wording in the fundraising appeal language, making it clear to donors that in circumstances where the appeal does not succeed for any reason, either because you've raised too much money or too little, then the donation can be made available for other specified purposes, or indeed the charity's work more generally, thus avoiding any need to engage with these rules at all. Slide please. Slide again. So we're now changing gears to talk about permanent endowment. And here's just a quick overview. So the new law makes relatively substantive changes in relation to permanent endowment, better enabling trustees to utilise value that would otherwise be locked up behind the brick wall of a trust restriction. Slide please. So Stuart's already touched on this a bit. Here's a little bit more permanent endowment 101 for you. So it tends to come in two flavors. You have your investment permanent endowment, and this is the one with which we are all mostly familiar with, where you have an investment portfolio, produces an income to fund the charity's activities, but you can't spend the capital. So here the charity can only sell the investment portfolio with a view to acquiring another. It can't sell those investments to spend on the activities of the charity. With functional permanent endowment, we are talking about a property, typically, that can only be used by the charity to fulfill its charitable purposes. And the classic examples would be a village hall or, say, a recreational ground. And other features, just to note in passing, about permanent endowment is that because it is trust property, it means that where you have a company or a CIO, those entities will almost always be holding those assets as trustee and not beneficially. So this means, for example, that where the company is dissolved, the permanent endowment will continue to live on. There's no bone of contention in relation to permanent endowment. And depending on how the trust restriction was defined, it may well be placed beyond the reach of general creditors of the company or CIO. And just to be clear, the changes made by the new Act, the 22 Act, which I'm going to touch on now, concern only investment permanent endowment. They don't apply to functional permanent endowment. Slide, please. So the 22 Act introduced a new definition of permanent endowment. So the old definition in the Charities Act 2011 had been criticised for being unclear because it created an unhelpful presumption that funds held by a charity should be regarded as permanent endowment unless particular conditions were satisfied to rebut that presumption. And you can see from the slide that there were also unhelpfully two limbs to the old definition. The first limb talks about there needing to be a distinction between capital and income, whilst the second limb refers to there just needing to be a restriction on how the charity could spend the property. And nobody was quite sure about how these two limbs interacted or related to each other. The new definition, by contrast, is much tidier and purges most of that confusing language and removes the idea of there being a presumption. It simplifies the definition to something much more obvious and recognizable, i.e. to mean capital held by a charity which cannot be expended. The other thing to keep in mind is that whilst the new definition of permanent endowment is broadly framed, it still may not cover every type of permanent endowment restriction which may attach to charity property and which you may encounter. And indeed, it was never intended that the statutory definition should codify the meaning of permanent endowment. So it is still possible that certain strains of permanent endowment will fall outside the scope of the definition. However, for our purposes, we're going to concern ourselves only with the statutory definition, for the obvious reason that only property which falls within the parameters of the definition will unlock the associated powers afforded by the legislation. Slide, please. So it's just worth looking back for a moment, because under the old legislation, trustees could release the restrictions on spending permanent endowment capital without commission consent, provided the trustees were satisfied that the purpose of the trust could be carried out more effectively if the capital could be spent and you fell either within the income or the capital threshold. So for income, it had to be less than £1,000, and for capital, it had to be less than £10,000. Anything over those thresholds, commission consent was needed, and the commission had a relaxed 3-month period to respond, or rather not object to the trustee resolution releasing that restriction. And when making that decision, the commission would be obliged to have regard to the wishes of the donor and to consider whether it will be necessary for the charity to give public notice of the resolution. The old law under the Charities Act 2011 had some rather unhelpful grey areas. So, for example, it wasn't terribly clear as to whether this power to spend capital was available to corporate entities. It wasn't clear as to whether it only applied to a permanent endowment fund, which was itself registered as a separate charity. And it also wasn't clear whether that £1,000 income threshold referred to the income of the permanent endowment fund alone or to the charity as a whole, which would obviously have a significant bearing on the availability of the power. Slide, please, Stuart. So the new Charities Act 22 definition simplifies all of this. The capital value threshold has been increased to £25,000, and the income threshold has been removed altogether. Where the fund value exceeds £25,000, the 3-month period available to the Charity Commission to respond to a trustee resolution has been reduced to 60 days from that 3 months. Although that time period may still be extended where the charity must comply with any public notice requirements that may be imposed on it by the Commission. So the effect of this is to simplify the operation of the statutory powers and enable more charities to spend smaller permanent endowment funds without the bureaucracy and cost of charity commission consent. Of course, there were quite big funds in capital value terms, which in a low interest environment produced a lot less than £1,000 worth of income a year. And under the new rules, it will now be necessary to get commission consent for those funds, whereas under the old rules, that wasn't necessary. Slide, please. So the new Act's introduced a new statutory power enabling trustees to borrow from the permanent endowment without having to obtain prior authorization from the Commission. And this power will effectively be implied across the board for all charities unless it's expressly excluded by the Charities Constitution. And helpfully, the trustees are free to use the borrowed money for any activity within the parameters of the charity's purposes. So it's not limited in any way by the trust restriction that was attached to the permanent endowment fund from which you borrowed the money. The power is available to the trustees provided that they are satisfied that the borrowing would be expedient in the best interest of the charity, which is essentially the same test that the Commission would apply to itself when providing an order to trustees to authorize borrowing. Slide, please. So there are limits, and the new law includes the safeguards set out on the slide. Just running through those quickly. A maximum of 25% of the value of the charity's permanent endowment can be borrowed. And I would flag that this is not a static amount. So further borrowing would be permitted if the value of the permanent endowment fund increases, thereby increasing what could be regarded as 25%. So you could borrow 25%, the value of the portfolio could go up, and you could then borrow whatever addition that was that's taken it up to 25%. The repayment period must be no longer than 20 years. The charity trustees are required only to repay the sum actually borrowed, but they can elect to pay more than they borrowed to reflect capital appreciation if they want to. And any repaid sums are rendered subject to the original permanent endowment restriction. So once you paid it back, it's locked up again. The trustees will be required to exercise the power in line with their existing duty of even-handedness in terms of present and future beneficiaries, which Stuart touched on earlier. And the trustees must be satisfied that arrangements are in place for the amount borrowed to be repaid within the permitted 20 years and should obtain advice to ensure those arrangements are adequate. So, if you're cynical, one might be tempted to think that trustees who will be long gone when it comes time to pay it all back may be inclined towards being quite optimistic in terms of their repayment projections. And the trustees would need to seek directions from the Commission if it appears that they will not be able to repay the borrowed amount, of which more in a moment. Borrowing in excess of 25% will require Charity Commission consent under the existing powers found at section 105 of the Charities Act 2011, which is not changing. Slide, please. So what about oversight? Well, there are no specific enforcement mechanisms or supervisory regime in respect of this new borrowing power beyond the Commission's existing powers to intervene in a charity where it has regulatory concerns. So this means trustees can borrow and spend the money all without reference to the Charity Commission. Whilst there is no Commission supervision, trustees will be required to have a repayment plan in place and will need to account for their progress as against that repayment plan. And we envisage the SORP being updated to provide that charities must account for the borrowing either in their annual report or in their accounts. And this would probably include providing details of their repayment plan and their ongoing compliance with it. So what happens if the trustees after 20 years cannot repay the sum borrowed? Well, then they will need to seek an order from the Commission providing directions as to how they should proceed. The Commission's approach to this will be set out in new operational guidance, but as of today's date, that has not yet been published. But broadly speaking, the Commission would decide either one, to extend the repayment period, so beyond 20 years, or two, to require the trustees to come up with a new repayment plan, or three, to remove the obligation to pay the money back altogether. With regard to that last option, the trustees would be obliged then to use the statutory powers to spend permanent endowment, which have been extended by the 22 Act expressly to cover off circumstances where the trustee should be alleviated from the obligation to repay the outstanding amount. Subject, of course, to the trustees first being satisfied that the charity could operate more effectively as a consequence of this money not being repaid. So, for example, if trustees borrowed £35,000 of permanent endowment and then they paid back £10,000, they could use the new DIY statutory powers to spend permanent endowment, which I just talked about earlier, effectively to write off £25,000 of the borrowed amount. Slide, please. Just a quick note on total return investments. So given that social investments may in some cases be uncertain or loss-making in nature, where investors sometimes expect to get less money back than they invested in the first place by virtue of wanting to achieve a social aim, it was not possible to use permanent endowment to make social investments, as you would essentially end up spending or losing permanent endowment capital by the back door due to the anticipated investment loss. Given that social investments are generally regarded to be a good thing for charities to engage in, a new section 104A has been inserted into the Charities Act 2011, which will enable trustees to adopt a power so that they can use permanent endowment to make this type of negative or loss-making social investment. And this power is limited to charities that have already opted to investing on a total return basis. And we can all picture Stuart's wonderfully colourful chart, which essentially enables a permanent endowment fund to use both the capital gain as well as the income for charitable expenditure. And new regulations will soon be forthcoming to govern the use of this power. So thank you. I think that's the end of my session. And I think we're now open to questions.
Okay, thank you so much, Jonathan. It's Stuart, if you could come back on camera as well, brilliant. And thank you both so much for your presentation. You'll see from the Q&A box that we've got plenty of questions waiting for us here. So clearly a topic that's very much of interest. I will prioritize the most popular questions, so please make use of the upvoting function, but I'll get straight into it. So question from Philippa. How can you close small restricted funds where the balance is now not material if one can't transfer to the general unrestricted fund? Stuart, would you like to take this one?
Yeah, sure. I think it goes back to some of the rules actually that Jonathan was talking about. So if you've got to, you can't just simply clean it up through a transfer. If you've got funds that have been raised and are restricted, then unless you've got some of the rules that Jonathan was talking about in terms of CPRE and failed fundraising events and so forth, you don't really have too much of an option other than going back to the funder and asking their permission.
You were listening, Stuart.
Always helps, doesn't it?
Jonathan, was there anything you wanted to add to that, or is that?
No, that's quite right. You could either use the DIY powers available under the Charities Act, new or old, but new now, essentially to move those restricted funds, to release the restriction on those funds, and so they will become unrestricted. And if they fell outside those thresholds, then you'd have no choice but to apply to the Commission to make your case.
Thank you. A question from Stephanie next. What are the implications of not spending restricted income funds within a reasonable time frame? Is there any regulatory action from the Charities Commission?
I think that is a technical breach, and the Commission probably have other things on their mind other than chasing down charitable trusts, which are so they don't have the power to accumulate income as capital, which Stuart touched on, and they were just retaining income from one year to the next. Then I've never noted the Commission take that up. It could be something that a donor or a supporter of that charity might notify and might raise questions about. So typically, trustees in those circumstances should have a project in mind to which they are earmarking those funds to spend on for the future, and that will be usually enough justification. But I haven't seen the Commission take the point, although, as Stuart quite rightly said, there is a positive obligation on the trustees to spend money in those circumstances.
Great. Stuart, was there anything you wanted to add to it, or shall I just jump to the next question?
And I think it would probably be picked up as part of a wider. If the Commission had concerns overall against the charities reserve position, I think that's where it's probably likely to be picked up rather than anything in isolation. Next
question, Stuart, is for you from Simon. Restricted funds and support costs. What is reasonable? Simon says he's seen certain restricted fund agreements where it specifies the costs, for example, a percentage of the total project costs being support costs.
Yeah. So when I was talking through that slide, I said, if there are specific terms within your grant agreement that says about, you're only allowed to put certain amounts of overheads or support costs towards this grant, then that supersedes it. If it's absent in there, reasonable support costs being allocated is the benchmark that you need to go to. You've got to, asking an auditor what's reasonable. I'd go. There is no set percentage, but if you've got a justifiable mechanism, and it's apportionment of costs, so you just need to pick a metric by which you're going to use, and that would depend on the nature of what you're doing. Often it's staff time, headcount and so forth, and what they're doing in terms of their time allocation.
Great, thank you. The next question is about cash flow. Is it ever appropriate to use restricted funds or restricted cash to support cash flow? For instance, using a donation that has been received but will not be used immediately to avoid otherwise having to borrow to fund day-to-day activities? Or should charities ensure that the cash that comes with restrictions is kept separate from cash that is being used in the day-to-day business?
I would go first on that one in terms of, I think that's a bit of a legal point, because I'd say you're on pretty dangerous ice, because if you're basically making the assumption that things will come good, that you can use restricted funds for general charitable purposes in the hope that you will get unrestricted donations back in the future that will allow you to meet the terms of that restriction, I think you're on pretty dangerous ground. But I'm sure Jonathan might have a few words of.
I think that's right, because on the face of it, or prima facie, as we like to say in legal profession, that would be a breach of trust in relation to that restricted pot. So you're using the money for things that you're not permitted to use the money for by virtue of the trust restriction. However, I suppose within the confines of a financial year, if you are certain that you're going to get unrestricted money coming back in, which will make that restricted pot whole, I don't think that would be an unreasonable thing for the trustees to do. But I think that would all have to be taken in the round before making that kind of decision.
Thank you. Next question is from Sarah about restricted funds and appeals. Sarah says that small charities say that they have to use very restrictive wording to get the donations. they then get stuck with onerous accounting for just small appeals. If they say for this appeal or similar, they don't tend to get the donation. So small charities often get bogged down with many restricted funds and onerous accounting. How can we reduce all of this complexity for charities?
Well, I hate to say it, but the name of the game here is to be as transparent as possible with the donor prior to them making the donation. So if you're giving the impression that you're going to do one thing with it, then and the donor is making the donation based on that, then you really need to follow through on that. And if you're not able to make a sort of compelling case for the wider piece, then I'm afraid that is just something that you have to live with as a charity, because you're quite right that if you don't use appropriate language or broad language in your appeal to demonstrate this is like illustrative of the work that we do, and it's not definitive of the work that we do, and we can use the funds for our general purposes. If you don't use that sort of language, then you can end up with a whole myriad of restricted funds, and which can cause you much sort of wider problems in their ongoing administration. So I think I think this is an art and a science in terms of getting your fundraising language nuanced enough just to strike the right chord that you want to.
And just for statutory accounts purposes, I did highlight in my slide that where you've got small funds of similar nature, you can group those for statutory reporting purposes. So that cuts down at least a little bit of what the narrative needs to say in your statutory accounts. However, back in your own internal management accounts, you do still need to track each individual fund separately.
Thank you. The next question is, I think, about whether trustees can create a restriction themselves, or whether it always comes from the donor. So from Robin, do restrictions have to be explicit? For example, if a legacy is left to the village church, can the trustee treat it as being restricted to use on the church building, i.e. added to the fabric fund, or will the legacy have to be treated as unrestricted as there is no written restriction?
That sounds like a specific question about a specific issue to me. And dare I say, I'm going to cop out here, but the restriction is one of those things which you have to examine precisely by virtue of the language which is used. And so if it's just funds left for the village hall, say, then to my mind, that gives trustees quite broad discretion regarding how they then use those funds relative to the village hall. And that's probably as far as we can go with that question, I think.
Thank you. I think we have time for one more question. So going to David's question. Is there detailed guidance on what costs are support costs that can be split between the various restricted funds? For example, would these costs include costs of promoting the charity generally, preparing newsletters, and attending profile raising meetings?
Yeah, so as I said, there were three elements that you pop into that funnel. The direct one's the support costs, and then it's other associated. So what we tend to sort of see is direct are very very obvious, and that's really there's not too much judgment that needs to apply there. Support costs, again, you know, they can be pretty well easily identified because, you know, there is an interchange between overhead and support costs that sort of go back, and you know, you're typically dealing with finance, HR, and back office services, and then actually it's that other bit, other associated costs, where you know, actually costs of fundraising and costs of managing funds, those are directly, you know, that's absolutely appropriate to allocate towards restricted funds. Again, it's all about, you know, methodology and justification, reasonable fairness, openness, transparency. Once you get into those principles, you can't really go too far wrong.
Wonderful. Thank you both so much for your presentation. You can see that the questions are still coming in, and I'm sorry we won't have the time to address any more today. But please keep an eye out on the charity community, because we will try and follow up with them in more general terms. We won't probably be able to respond to you individually, but just sign up for the charity community, which is free of charge, and then you will receive any follow-up action. But that brings us to the end of today's webinar. I would like to say a big thank you to Stuart and Jonathan for refreshing and enhancing our knowledge of fund accounting, and a special thank you to MHA for supporting this webinar. And most importantly, I would also just thank you, our listeners, for your time and for your many questions. I hope you have found this session very useful. A short feedback survey will pop up on your screen after the webinar finishes. Please make sure you complete this, as your feedback is very important to us. And this is one of the webinars that has come out of requested topics. So please send us your wishes and we'll do our best to meet that in 2024. The webinar has been recorded. You will receive a link to the on-demand recording and the slides and everything else that we've put in the chat in tomorrow's email. But with that, I just say thank you to you all and enjoy the rest of your afternoon. Goodbye.
Thank you, guys.
Thanks very much. Goodbye.